The CBN has increased interest rates from 22.75%, which it was at the MPC Monetary Policy Committee meeting before the one last had. And then in the last one, it increased it again by 200 basis points to become 24.75%. Now, what would be the implication of this on the economy and on businesses? We're bringing our guest who joins us virtually is Orji Chigozie, Managing Consultant, CEO, Flame Academy and Consulting Limited. Good morning, happy Good Friday. To the CBN, this bring up a surprise. I call it a surprise because it was thought that they were done increasing rates at least for a while, only for interest rate to be increased again to 24.75%. Do you consider that high? What are your thoughts about it?
All right. Well, it's expected that the kind of inflation we are fighting, that the central bank will not stay quiet about it. Usually, once you have to battle inflation, what usually happens is the central banks all over the world tend to do what we call monetary tightening. That is hiking of rate. It is believed that usually or generally inflation is caused when so much money between too few goods in the market. Supply is much higher than it should be, and it's going very. And the core mandate of central banks all over the world is to manage inflation, curtail money supply, price stability, or what you may call monetary stability. So the key instruments include the cash reserve requirement, liquidity requirement, discount rate or monetary policy rate, treasury bills, and like a Nigeria open market operation, OMO, trying to either inject money into the economy or withdraw money from the economy. So in this case, Nigeria is facing a very huge challenge with inflation. Inflation is currently trading above 31%. So it is expected that central bank will want to do something, which traditionally is, to jack up rates to be able to rein in inflation. And that they have done in their two recent Monetary Policy Committee meetings. In the one they held in February, they moved rate from 5%, that's a monetary policy rate, moved by 400 basis points or 4 percentage points from 18.75 to 2.75. And then they held a meeting again last week and further jacked up the rate from 22.7 to 4.75. All right, so that has been expected, knowing that the MPC meeting that was last held under Emefiele was in July 2023. So nothing had been done over the months that Nigeria had to battle inflation. But then there are some negatives to these steps. And as we go on in this conversation, I will mention them because we like to copy what goes on around other countries of the world without looking at the peculiarities of our own economic challenges. And of course, we also need to mention that in the first MPC for the year in February, they also jacked up cash requirement % to a whole 45%, which for me a crazy, policy announcement. Because what we're doing now is to fight inflation at the cost of the so much desired quantum growth in our economy. If you remember, our dear president had set a target for Nigeria, an 8-year target for Nigeria to move from about 400 billion GDP size, that's gross domestic product, which is a measure of national wealth or national income. That Nigeria should be a $1 trillion economy in the next 8 years. And for us to do that from where we are now, around $400 billion economy, it means we must be moving at a double-digit economic growth rate. Unfortunately, with the current trend of inflation fight, growth is now pushed at the back seat. In fact, growth is being traded off, for the fight against inflation. And that should concern everyone who wishes this economy well, in the long run. Thank you.
All right, good to see you again. Let's help Nigerians to understand the implication of this increase in interest rate, which is the critical issue here. Now that the CBN has decided to increase it to 24.75%, what is the impact of these on the economy? And then what will be the impact of these on an average Nigerian, especially investors who are also key about these statistics?
Okay, there are a number of pros and cons for interest rate increases like this. In the first instance, when interest rate is increased, in the market, generally, people tend to want to save their money and invest them in some short-term instruments, therefore making them have a higher propensity to save than to consume. And with monies being now saved and invested, less amount of money is available to be spent in the economy. Therefore, theoretically, driving prices, that's the primary aim of that, to manage inflation, drive prices down, or to stabilize. Okay, and in doing that, in an economy where you have inflation going above 31%, and you have your benchmark interest going initially at 18.87% to the 4.75%, you find that real interest rate in that economy is negative. What do we mean by real interest rate? Interest rate adjusted for inflation. For example, if you were to keep your money with central, for example, or use the NPR 24.7 to represent the prevailing rate in the, assuming you invest in the Nigerian economy as much as 24.75% over 1 year per annum. But then it will lose value at the rate of inflation of 31%. It means that if you keep your money in Nigeria at that rate of 24.7 for 1 year, your money will grow at that 24%, but it will devalue by 31%. That means there's a negative interest yield or interest rate of about 6 or 7%. Now, compare that to somebody who gives his money to the bank. Let's say the banks are giving up to 50% now, which is still almost impossible. You drop your 1 million naira or 100 million naira with any commercial bank in Nigeria, thereby they're paying you 15% on your. Then, after a year, money has lost value at 31%. Immediate business by keeping your money in the banking system. The money grows at the rate of 15% that the bank offers. The same money is also devaluing at 31% inflation rate. So what central bank is trying to do by propping up rates is to close the negative interest rate, to likely close it up, or even if possible at a point, achieve a positive real interest rate in the economy. And this gap, or even at economy, is a very good incentive for investors to come into the economy, both domestic and foreign investors. Even though for foreign investors, they are usually portfolio investors who come in to take quick advantage of your market instruments to earn quick profit. Portfolio investors are short-term investors, and they're usually attracted by high interest rates. Because if they were to invest their dollar in the US or some other or Western economies, they might not get anything more than 3, 4, 5%. But were they to come to Nigeria, for example, if you have a big enough market to attract them, they may be going away with 21% on our treasury bills and things like that. Interest rates are, pushed up. It's an incentive to, attract foreign investors. You know that at this point in Nigeria, where we're trying to open up foreign exchange inflow, and that policy is not only trying to help fight inflation, also trying to help to attract foreign portfolio investors who will usually come with a portfolio of dollars, filled with dollars, USD, which Nigeria needs so much more now than ever before. So that policy is meant to attract investors who will come and offload their short terms with us. But because we are very hungry for dollar right now, in the short term, it helps us to solve our problems of dollar illiquidity. Even though we need to be that these monies are portfolio and may soon be sent back to the investors' countries, whereby while they feed us with dollars right now, they may soon be asking for their dollar back. And then when we don't have the dollar to give to them, or the dollar is likely to cost them more to get to fly their investment back to their country, it becomes a concern to them. And then for us as a nation, we are celebrating Naira gain today. We hope that tomorrow we will not, be mourning a worse decline in the value of Naira, because by the time the portfolio investor says that $5 billion I offloaded in your country 3 months ago, now my investment has matured, I need to give you back your Naira, which you gave me to invest in your country. Give me back the dollar to move back into my own country. And then if you don't have it to give to them, you may also experience kind of decline of volatility in your own US dollar, Naira rate.
All right, so the gain, which is the gain which will come from this increase in interest rate, which is currency stability, looks like it's going to be very much short-lived. Now, this goes to economic principle that central bank, not just Central Bank of Nigeria, but the central bank of many countries uses, which is hiking rates, trying to control inflation. It's beginning to look like a one-size-fits-all principle. But in reality, is it a one-size-fits-all? Would you rather the CBN takes a different approach than increasing rates?
It tends to draw out more from us in terms of trying to clarify these methodologies or tools of monetary policy implementation. All right, so monetary policy must not be a one-size-fits-all approach to an economy. Every economy needs to have credible data and evidence upon which policies are made. But one thing we lack in Nigeria is evidence-based policy making. We are always following what other countries are doing. Oh, the Bank of England, the European Central Bank, the US Federal Reserve, the Bank of India, or the Reserve Bank of India, and all of that. Whatever they do, we tend to copy them. The realities of Nigeria's economic problem, is such that those solutions we are adopting from them does not solve our problem. I mention it right now, and I hope you keep record of it, that if we don't try to look at other issues facing us as a country, we may get to that point where even these increases of interest rate may not solve our inflation problem. Why? Because in theoretical economics, you are told that inflation can be either demand pull, that is, where the high demand for commodities, because people are earning more salaries, they're getting more jobs, economy is growing very fast, people are doing well, and therefore demand, maybe it's easy to lend, to borrow from banks. Banks have too much money to lend out and so on. So in a credit economy like in US, when people have easy access to money, they tend to want to purchase more houses, domestic equipment and so on. and that tends to drive prices up. So in that case, you can say that the inflation is demand pull. And that's where increase in interest rates can help rein in that kind of inflation, because once interest rates go up, banks will no longer be able to give loans easily, and borrowers may no longer afford to pay those rates, because they have planned themselves, on and so on. So that kind of, can be curbed by rate increases. Come down to Nigeria. Tell me who is earning more salary? Who is getting better in terms of firepower in the economy? Nobody. The chunk of the population are driving further into extreme poverty. That has about 200 million people, also has about 1 million people or more that are in different levels of national poverty. And then the rest are barely surviving. Only about 1%, a very small economy, who have cornered the economy, the commonwealth of politicians and some, bourgeois. They are the ones who have so much money in their pockets, buying all the crayfish, all the food, all the so on in the market. So you find that inflation is not typically demand pull as such. There are other pass-through effects that bring about our own, and our own inflation is largely imported. Inflation is more of a cost inflation. Cost of the final products that we import from different, and cost of the input material, because even industrial sector, most of the raw materials that we use to produce one good or the other are also imported. And right from the importation of energy products like petroleum products, which is where our major problem lies. You have that transportation pass through to inflation. So, for example, with the Ukraine war and now Israel war, which also involves some oil politics, you find that the oil price has remained high in the past 2 or 3 years. And with the Ukraine war, that was that shock that we had. And what happened, the oil, and Nigeria being an exporting country, crude oil exporting country, instead of deriving a very big benefit from the oil price increase, making more revenue and more export earnings of dollars, we are very horrible side of it. Also now foolishly go back to import refined petroleum products, which is hurting us. And stop. Even the village farmer will feel the impact, and therefore the corn, the banana, the orange, or whatever he finds from his farm will also go up in price, because when they go to buy this in the market, they face high prices because of high energy costs, which has also caused a lot of increase in prices everywhere. And then even the imports that we have, and then the fact that we don't also have enough dollars to import things that we import, dollar rate has been going up against the naira, despite the short-term gains we have seen naira make in the past 1 or 2 weeks. Predominantly, Nigerians are always looking for dollar they cannot find to import the things that we always import. So until the level of import reduces, until we begin to export and get enough dollars to intervene or to provide for those who import things without allocating, prefer all of that, our inflation will continue to trend up. That's monetary tightening the central bank is doing. That's why there is a need now more than ever before for coordination and a very urgent need for fiscal authorities to play their own hand in trying to drive down the amount of in trying to encourage, non-oil export in different dimensions, in trying to promote export, in trying to ensure that the economy is more productive in different areas, and support in the medium to long term this inflation fight beyond just central bank trying to increase. Because if they keep increasing rates, they may soon get to a point where they say we are monetary policy exhausted. It happened under Emefiele, where we are using only monetary tightening to manage inflation, while other factors, like I said, too much importation of petroleum. But if we cut off petroleum import alone, the demand for dollar will crash. Then we have enough dollar to give to those who import other things, and this inflationary trend will also go down. So fighting inflation is not only this quick fix method we're trying to use, putting all the weight and all the trouble on the central bank's desk. They may get exhausted, because if they keep pushing rates up, as you push rates up, it becomes more exhausting for the common sectors of the economy, manufacturers, producers, and so on, able to find loan to produce more, to employ labor and business, and therefore we are fighting inflation while crippling economic growth in Nigeria. So central bank may soon get exhausted, where the increase in monetary rates may actually not drive prices down, because we are still importing a whole lot, and dollar is still not enough to support that import, which, like I've said, is the source of our own inflation. Cost push inflation, cost of finished goods that we import, and cost of imported raw materials that we need to produce here. So there must be a holistic approach.
So looking at the interest rate now at 24.75%, what would be the implication of that on businesses?
We are focusing here on the PR. Policy rate is just a benchmark rate in the economy to say that this is the rate at which central bank can lend to other institutions, other one, and also the rate which they can, keep money for you. For businesses, those who don't have so much to expect business, it may mean they may want to invest more of their idle funds. Some might even pack up. Instead of opening a factory that you don't know how much profit you will make, and you have stuff to worry about, pilfering and so on, several businesses might just go hiding. They pull up their capital and just invest in government instruments at such a very high interest rate, at no risk at all. So that might pull businesses down or make them unwilling to take risks. Because even by taking no risk, government will pay you a whole lot in their gilt-edged instruments. So that might draw businesses down instead of investing in their growth strategies. Very low for now. Money market instruments are in price on businesses, and that's why we say that when government is very bullish, trying to rein in inflation, they crowd out the real, that is, monies that the real sector would have got to be able to build their businesses through loans in banks. Those monies are channeled towards government as they fight to mop up liquidity and manage inflation. That's one. Two, with MPR going at about 25%, importantly, with cash payment now as high as about one of the top 5 or worst CRRs in the world, lending by banks, is going to become even more and more expensive, much more challenging, and so on. Therefore, businesses, like you asked, may find it more difficult to access bank loans. And when they do find these bank loans, they will get them at a very high price. And the combination of high borrowing rate, high price of import raw materials, and other costs, energy costs, high cost of, sustaining their productivity and so on, maintaining their offices and so on, you find that local businesses will now be competing in a very disadvantaged position against their foreign brand. Ideally, compared to foreign products, so that sell their products faster, to encourage local consumption, buy Nigeria and so on, and discourage imported inflation. So with this high interest rate, business costs in Nigeria will go further high. So coupled with energy costs and other cost of doing business issues, you find that local producers may likely find themselves producing without being competitive. And then it becomes much more attractive or much easier to sell imported and products. And that's going to deal a big blow to Nigeria's productivity. So that's on the negative side. Right? Then in terms of FX, if response from portfolio investors, the increase in interest rate can also, like it is already doing, see us opening up some few more windows for FX inflow, helping to temporarily stabilize the FX supply in the market and maybe enable businesses get dollar at slightly cheaper rates. There are other impacts, but these ones are very key. Thank you.
All right, let's wrap up with this. Let's get back to what happened at the first MPC meeting, where the CBN decided to increase the MPR from 18.75% to 22.75%. Now, the essence of doing this was to control inflation. But if you look at the figure released in February, according to MBS, the inflation rate increased to 31.7%. Would you say that inflation rate has defied the essence of increasing the MPR by 400% basis?
No, not at all. Not at all. The impact of that increase is not yet built into our data right now. I don't expect that. Usually there's a lagging time. When a policy is made, you expect some time to pass, because of indicators will show you whether the policy you announce is achieving its planned objective or not. So a policy made in February will not ordinarily have impacted the economy in March figures. No. So we expect that by second quarter, which will start next week, April 1 will be the beginning of second quarter of the year. So somewhere before the end of that quarter, we will now see how much impact the monetary tightening of the central bank, how much impact, it has had on the economy. So data from May into the third quarter, beginning July 1, is what we'll use to see whether the fight against inflation is succeeding or whether it is yet a chase after the shadow.
Way to wrap up this conversation, we must thank you for your submission and also creating time out of your holiday. It's Good Friday. You're taking time to have this kind of conversation with us. Thank you so much for your time and commitment.
Thanks for having me, and God bless you all as we celebrate Easter, when we celebrate the power of the risen Christ. I wish you guys all the best in your studio and in your work. God bless you.
Early exchange, shaping policy, advancing development.